Investing in the financial markets is one of the best long-term approaches to wealth. But at a slow and steady pace, many investors probably wonder how long it takes to make $1 million using the stock market or treasury bonds. Let's take a look at how to scale to $1 million plus in the stock market. Number 6. The stock market is a credit card you issue. Much like a credit card given to you by a bank with the expectation of interest payments, you give money to someone expecting a return on your investment. Both use the same guiding principle, compounding interest. The value of your initial investment grows exponentially over time. In simple terms, compounding is the cycle of generating additional returns on the money that you previously invested. The stock market is one of the greatest wealth-building tools that exist. As long as you follow a few key rules, you'll need to know what you're investing in, watch your fees, build a diversified portfolio, and invest for the long term if you want the best chance to build wealth in the market. Let me rephrase that. It takes a lot less work to become a stock market millionaire than you think. In fact, the most work you do is at the beginning of the process. Once you have your foundation laid, you can pretty much put things on autopilot. How great is that? If you take about an hour or two of your time now to lay the groundwork, you are 95% of the way to becoming a stock market millionaire. Number 5. The stock market and savings. If you've watched The Wolf of Wall Street, you might have found yourself almost admiring Jordan Belfort. But making money on the stock market isn't nearly as glamorous as the movies make it out to be. It's also not as profitable for the vast majority of investors. You're just as likely to lose some or all of your investment capital as you are to bank millions. If you're wondering how to make $1 million in the stock market, then the answer is slowly, in the vast majority of cases. It's highly unlikely you're going to hit a home run and walk away with overnight millions. The trick with investing in stocks is not to focus purely on the value of the stock right now, but instead on its future potential value. People who invested $1,000 in Netflix stock 10 years ago would now have a portfolio worth at least $50,000. This is 4 times the return you would have made on Apple stock. It's 20 times the return you would have achieved with Disney stock. Remember, you're looking for outlier stocks that will outperform the norm. So, it's clear that you definitely can make a huge return on investment with the right stock. You will need to find 20 other stocks that perform as well as Netflix to make $1 million within 5 years. It's possible you might do that, but your time and effort might be better spent on business models that offer a more immediate return on investment. Investing in stocks can make you a millionaire. It just takes a lot longer to do it that way. It is possible to make your fortune with a managed savings account. It's just going to take 30 plus years because of the savings rate. Number 4. The timeline to $1 million. The stock market can also make you a millionaire pretty quickly if you pick the right investments and put enough money into them. Many people aren't great at picking stocks that beat the market, though. So investing in index funds that track the market's performance is often the right way to go. If you do that, you can expect to comfortably earn around a 7% to 8% average annual return over time. As you can see, if you're making small investments, it will take a long time to hit $1 million. That may be okay if you're investing for retirement and you start in your 20s. But if you're in your 40s and want to become a millionaire soon, you're going to have to be much more aggressive in the amount you invest. Putting money into the market early on in your life allows plenty of time for compound interest to work its magic. Compound interest occurs when your investment returns are reinvested and earn returns of their own. It can lead to exponential growth and, when given enough time to work, can make it easy to amass a fortune even when investing small amounts. You can't go back in time and start investing $100 a month at age 20 if you're already middle-aged. But These numbers show that it's not out of reach for most people to become millionaires if they start in their 30s or even their 40s. Saving $1,500 a month starting at age 45 would still allow you to achieve millionaire status by about the time you hit your full retirement age for Social Security. While $18,000 a year in investments would be a reach on an average salary, it could be doable if you're putting money into a 401k to take advantage of tax breaks and you get an employer match to help you hit your target. Obviously, you can make amassing a $1 million nest egg a lot easier if you do start early, though. And since you can't go back in time, right now is the best time to begin investing if you haven't already. Even if you start small and can't invest the requisite monthly amount to get to millionaire status, try to invest something to get your money working for you. Over time, hopefully the market can make you a millionaire. Number 3. A simple math example. Imagine it is March 13th, 1986. The date a new company called Microsoft had its initial public offering, IPO. Cars that year retailed for around $10,000. But what if instead of buying a car, you decided to purchase a block of shares in Microsoft? By 2020, that investment would be worth $13.7 million. The power of a single good investment is that it is able to overcome a lot of disasters. Go back to 1986, only this time, assume that you divided that $10,000 into 10 different investments of $1,000 each, just one of which was Microsoft. Assume you somehow managed to construct the single worst, awful, statistically improbable portfolio imaginable, and 9 of your 10 holdings immediately go bankrupt the day after you acquire them. Such a catastrophic thing is hugely unlikely, but for our example, say it's taken place in this alternate universe. How would you have fared? You invested $10,000 and immediately lost $9,000. 90% of your investment is gone. But overall, you still did fantastically, believe it or not. By 2020, you'd still be sitting on $1.37 million thanks to those 34 shares of Microsoft you bought in 1986. And that doesn't even include your cash dividends. Whether it's a beachfront property acquired in Malibu 50 years ago or shares of Coca-Cola bought in the 1960s, a well-constructed portfolio can tolerate incredible doses of failure while still generating satisfactory returns thanks to compound interest. Number 2. Investing is the key. You can't be jumping in and out of the market, chasing returns and trying to pick the best time to buy or sell. You have to have a strategy and stick to it in both good times and bad times. So what exactly do you need to know to become a stock market millionaire? If you don't have a plan, how do you know where you are going? Better yet, how do you know you have succeeded? You don't. When it comes to investing, having a plan is crucial. Most investors jump around from investment to investment. They never see any real increase in their portfolio values, so they give up investing. They think the stock market is rigged against them. What most of these investors fail to have is a plan. If they had a plan to follow and they followed it, they would be successful. By having a plan, you can assess if you are on a track to meet your investment goals. If you find you are not on track, an investment plan helps you to make changes along the way. The general rule of thumb is to invest in stocks for any goal that is more than 5 years away. Any goal shorter than this should have your money invested in bonds or in a savings account or certificates of deposit. Number 1. Track your progress. Stay on top of how your investments are performing and rebalance as needed to ensure you earn the return you need to reach your goals. Unless you track your progress, you'll never know if you are on track for meeting your long-term goals. Over time, as the market moves, you might see that you are investing in more stocks than bonds. This means you are taking on more risk than you are comfortable with. By tracking your investments, you can correct this so that you stay on track. Likewise, maybe you now have more bonds than you are planning on holding. This too can be a problem since bonds tend to have a lower rate of return than stocks. If you are investing too much in bonds, you run the risk of not earning the return you need to meet your goal. To balance your holdings at the correct allocation, you will need to rebalance. This means selling holdings that have grown in value and buying those that have decreased in value. On the surface, this might sound counterintuitive. After all, why sell the holdings that are making you money? By rebalancing, you are guaranteeing that you buy low and sell high. You take the emotion out of investing, and this is a major factor in your success with investing. Do let us know in the comment if you have ever invested in stocks. Please subscribe to The Stock Advisor. Thanks for watching.